the benefits are mostly going to the very rich. It's about $54 billion in total. About 55% of that went to the richest 20%. They got more than the other 80% combined.
Oh my God. That's horrendous.
One for Mum, one for Dad, and one for the country.
And there has never been a more exciting time to be an Australian.
Budgets are about choices, Fran, and you show what you value through the choices you make.
This is coal. Don't be afraid. Don't be scared. The Treasurer knows.
I want an economy that works for people, not the other way around.
We'll just end up being a third-rate economy, a banana republic.
Just follow the money.
G'day, and welcome to Follow the Money, the Australia Institute's podcast that explains economics, politics and policy in plain English. I'm your host, Ebony Bennett, Deputy Director at the Australia Institute, and Australia is one of the wealthiest countries on the planet. We're so wealthy that while we can't have everything we want as a society, we can pretty much afford anything we want. And our tax system proves it. We're often told by the government that there's not enough going around to be able to tackle the housing crisis or the climate emergency, for example, but there is enough to give mining and gas companies cheaper fuel, to help people who own multiple properties to reduce their tax liabilities, and to help private schools pay their principals over $1 million a year. But it doesn't stop there. According to Australia Institute research by Min Nok Le, the Australian government gave up more than $54 billion in revenue through superannuation tax concessions in 2022-23, with the majority of that going to the top 20% of income earners. And joining me today to discuss the Australian government's incredible generosity to the wealthiest Australians is our Chief Economist, Greg Jericho. Thanks for joining us, Greg.
No worries, Zeb. Great to be here.
So I guess I'll start with some of the usual talking points. Isn't encouraging people to save for retirement a good thing, Greg?
Oh, it is. It's a very good thing, and Australians are actually pretty good at saving for our retirement, and the main reason is the government is very generous at helping people save for retirement. That's not the bad thing. The problem is all of our superannuation system is pretty much geared to encouraging people to save who actually don't need any encouragement. And so it's not really delivering any sort of public benefit. It's just helping rich people keep their wealth and get wealthier.
So these concessions are meant to be taking pressure off government spending by reducing the cost of the age pension. But it's not really worked out that way, has it? What do the projections actually show about the trajectory?
Yeah, that's the key point. I mean, the whole thinking behind superannuation and having the tax concessions on superannuation are designed to try and reduce the burden on the age pension. And basically, so government can either spend money on age pension, or it can say, right, you guys are going to save for your own retirement. We'll give you a bit of a tax break in doing that, so it's in your favor to do that. So that means when you retire, we don't have to pay you a pension. And hopefully that means over time, the amount we're spending on the pension goes down and everything's wonderful. Problem is, what we're seeing at the moment is actually the reliance on the pension is not going down because all the benefits, or a vast majority of the benefits, are going to the wealthy people who are never going to be on the pension anyway. What's happened is the cost of all of these superannuation concessions is growing fairly strongly, shall we say, and the work done by Min Nok Le shows that kind of by the middle of the 2040s, so around 2045, the cost of the superannuation tax concessions is going to actually be bigger than the cost of the pension. And that's not because there's going to be fewer people on the pension, so you think, oh, that's okay. No, it's just because there is so much money that is going to be going to the very wealthy in superannuation.
We know that women, because of their various caring roles primarily, but also because of the nature of the work that women predominantly do, retire with a lot less super than men. So when you take time out of the workforce to care for children, you don't get super going into your super account, and that contributes to the super pay gap.
So I want to drill down a little bit into that research, and I know that Min's research also found, and we've got a long history of our research showing that The current arrangements are especially bad for women and low-income earners. Can you just explain why that is, I guess?
Yeah, let's think about what we're talking about with the superannuation concessions. There's two types. There's the concessions on when you put money into your superannuation fund, whether it's by your employer or yourself. You're not paying the same amount of tax on that as you do on your income tax. And then there's also superannuation tax concessions on your earnings. So your super fund, you look at your super fund and, it's gone up $15,000 this year due to the investments that it's made. Well, that is earnings, and we know income is taxed. But what happens with superannuation, it's just taxed at 15% rather than whatever your income tax would be taxed at.
So if you're a high income earner, you're getting much more benefit, basically, because you get taxed more on income tax and you get a much discounted rate for your super.
Yeah, so if you're earning more than $190,000 now, the top end tax bracket is 45%. Well, you're not paying 45% on earnings over $190,000 in your superannuation. You're only paying 15%. So that's a pretty nice tax break. So when you think of it in that terms, the more wealthy you are, the higher income you are, the bigger that tax cut is, essentially. Whereas if you're only on minimum wage, you're not actually paying much tax anyway on your income tax because of our good progressive income tax scales. And so the benefit of that tax concession of super of only paying 15% isn't so much. So that's why the benefits are mostly going to the very rich. And, Min pointed out, it's about $54 billion in total. About 55% of that went to the richest 20%. They got more than the other 80% combined.
Oh my God. That's horrendous.
That is horrendous. And it's a case of, we're talking people who are doing really well, earning.
Probably not having trouble saving for their retirement.
Yeah, I mean, these are people who are earning around, or at least, $150,000, $160,000 a year.
Yeah.
And think about the median income is around 75, 80, around there. So doing well.
Yeah.
And getting the biggest benefit from these tax concessions. But also, as you point out, most of that benefit is also going to men because, one, we know also from all our work on gender pay gaps, men have higher average pay in just about every occupation, or 96% of all occupations.
Including midwives?
Including midwives, yes. And so when you think about it, you combine that. Who's getting the benefit? Well, the more income you have, the bigger the benefit. But also we know throughout your employment life, men are more likely to be working full-time, less likely to take time off. So when you think about the benefit of superannuation, it's that cumulative thing because you're getting super hopefully from as soon as you start work or up until you retire. The average male is working in their early 20s till they retire, and unless they've lose their job or something like that along the way, but generally they're staying there, whereas women are much more likely to at some point leave the labour force, either to raise kids or whatever. And when they do that, they're not getting super put into their super funds by their employer. So unless they're doing it themselves, which is hard to do when you're not working, they're not getting any super, they're not getting any benefit of that. And so, if we look at the figures, when you get to around retirement age in your early 60s, the median superannuation balance of men is around 200,000. For women, it's about 150,000, so 25% less, which is a fairly, it kind
it's
of
a
accords.
Substantial chunk.
Yeah, it kind of accords with what the gender pay gap is.
Yeah.
It's about 25%, up or down across the years. And so that's a substantial difference. But when you think about it, you're getting a tax break from putting money into super and from your earnings. So the bigger chunk of all of that total tax break is going to go to those who are able to contribute the most. Well, that's going to be the rich people who have got lots of income, can afford to do it. People who have worked their entire working lives, that's more likely to be men. And you combine those two together, the biggest benefits are going to men in high-paying occupations.
So probably not the way that if you were designing superannuation today, you would want the outcomes to be. This was really designed for an economy where men are the breadwinners and women are at home kind of looking after kids, essentially.
Yeah, I mean, look, there's nothing wrong with superannuation in the sense of it's a good idea, and certainly we're fully supportive of superannuation. The problem is these tax concessions, which originally were geared to this sense of, it'll help encourage people.
Yeah.
It's basically been used by accountants of, hey, you know how you can avoid paying tax? Put it in your super, especially when you start getting closer to retirement age. Especially if you're wealthy, you're getting in your late 50s, you probably paid off your house, so you're not paying your mortgage. You've got a lot higher levels of ability to save, and your accountant's saying, hey, don't save it. Put it in your super. You're going to get a tax break on that, and you're going to be able to then take advantage of that in 5, 6, 7 years' time when you do retire.
Yeah.
And you've got all this money that you didn't have to pay income tax on. How great is that? It's a gift. And it certainly is a gift if you can afford to do that. If you can't afford to do that because you're on minimum wage or medium wage, your accountant's going, hey, put all your money in super. And going, yeah, great. How would you like me to eat?
Yeah.
I can't eat my super. And
so it's not that we don't want to encourage people to save. It's more just that the biggest benefit is going to people who don't really need it, and the people that you would want to encourage, they're getting much less of the benefit than you would want. So we kind of just need to retool it, essentially.
It's a bit like all tax cuts. We know the biggest tax cuts generally go if you earn a lot of money and pay a lot of income tax. If you're on, low incomes, you're not paying a lot of tax. So if the government says, we're giving you a tax cut, you're like, oh, great, that'll give me $2 a week or something like that. And it's the same with these tax concessions. The biggest benefit of tax concessions, whether it's for superannuation, whether it's for capital gains tax, negative gearing, they go to those who have the most capital gains, the most superannuation contributions, the ones who are negative gearing the most, and that's the richest.
The federal government will double the tax rate of superannuation accounts worth over $3 million in what it says will save the budget billions.
Australians will see this change as modest and reasonable and fair.
It'll affect 80,000 people, including more than 50,000 who have between $3 and $5 million in their nest eggs.
99.5% of people with superannuation are unaffected.
Not only is it a major change, though, it's also a broken promise. And of course, we know that when Labor runs out of money, they come after yours.
So the government is proposing to reduce concessions, particularly for people with significant super balances. Can you just talk us through some of those proposed changes they're planning?
Yeah, the big one that they're planning to do is to reduce the concession, not remove it, just reduce it from being you only pay 15% to you pay 30% for superannuation balances of more than $3 million. Now,
I wish.
I'm going to suggest that not many of our listeners have got $3 million in their super. And if you do, you're in about the top 0.5% of all people who have superannuation, which is, there's about 15 million of us or so.
Not even the 1%, better still.
No, you're better than the 1%. As I said, the median, so half of people in their early 60s, half of men have a superannuation balance of around 200,000. Women, it's about 154,000, around there. We're talking 3 million. So it's not even double. It's just keep doubling and doubling and doubling until you get to $3 million. But it's not a case of, I've got $3 million in my super. Now I'm not getting tax concession on the earnings. And we're only talking the earnings here. So if you got $3 million in your super fund does really well. And let's say it goes up to 3.1 million. So that year you made $100,000. You're only paying the 30% tax on basically the amount that is above $3 million in your super. So
it works a bit like income tax.
Yeah, so
like
they basically work out what percent of that $100,000 is of your entire super balance over $3 million, and that gets taxed by 30%. The rest is just taxed as it always has been by 15%.
$3 million.
So it's not your first $3 million is still not going to change. We're only talking people who are making more than $3 million, and the earnings on that, they're still getting a concession. They're not paying it at the same rate they would if they actually had
$3 million.
Like if you're earning $200,000, all the money over $190,000, you pay at 45%. The rest below that,
Still getting a discount.
You're still getting a discount. It's just not as big of a discount, but it still only applies to that percentage of your balance that is over $3 million.
So it's a great change. It's just, it could definitely go further.
Yeah, well, I mean, it is the smallest thing, really, that the government could do. It's sure as heck is not communism, despite what some media organizations might have. It really, I mean, as I say, we're dealing with not even the top 1%.
Yeah.
And you think of it going back to the stage 3 where all the argument was about high-end income earners. We were talking, the 10, 15, 20% who were not getting as big a tax cut due to the changes. Here we're talking 0.5%. It is so minute. So it is a very small thing. It's a good thing. The government should be trying to wind back these concessions. What they've done here is wind it back to the very, very rich. We would suggest there's still a long way to go.
Yep.
When you're talking median super balances of 200,000, starting at the 3 million, it's not even a case of, this is ruining my aspirations. You can aspire all you want to getting 3 million. If you've got only 200,000 and you're 61, I'm sorry, you're not going to get to 3 million
Not going to get there.
in the final 7 years of your working life.
Well, I won't stop aspiring, but there was a big write-up in the Fin Review recently where a business owner kind of described this new tax, I think, as stealing my children's inheritance. I mean, is super supposed to be an inheritance?
No, and this is something that we really have seen. We saw it a little bit during the 2019 election where there was all that sort of talk about Labor coming after your inheritance and death taxes and everything. And what was quite revealing was a number of people, when they were talking about their superannuation, trying to keep the government's hands off it, is they were, in a sense, giving out that they wanted to be able to pass on their superannuation to their children. And it's a case of, sorry, that's not the purpose of superannuation. The superannuation is to allow you to maintain a comfortable or equivalent lifestyle to what you're used to while you're working. It's not something that you can pass on to your children. And where this is really crucial, I've got nothing wrong with you wanting to pass on things to your children. That's fine. But think of what we're doing here with these tax concessions. The only reason you do any sort of tax concessions or subsidies is because it's something that delivers a public good. It's our old saying, you tax the things you want less of, you subsidize things you want more of.
Yeah.
So, just real basic thing like charities. If you donate to a charity, because that delivers a public good, you're able to deduct that in your tax because the government wants to encourage it. Same with things like research and development. Governments will give tax concessions for that because it delivers a public good, because there's more innovation that helps the economy and everything. Same with tax concessions. Super, we give them because we want to encourage people to be able to save and not be reliant on the pension. There is no public good, though, from some very wealthy person being able to give a whole lot of money to their children. That doesn't make anything better for the government. It doesn't mean the government's going to not have to spend more money on little rich Jimmy and Lucy who suddenly have got all their mum and dad super, or to be honest, not even their parents. It's generally their grandchildren who are getting all this money. There's no public benefit from that. All it is fostering greater wealth inequality. It's completely against what the purpose of superannuation is for. And that is the problem, is we're seeing more and more the talk about superannuation is, the whole point of superannuation is for me never to have to touch my super.
Yeah.
I should be able to just live off the interest or the income of my super and not actually touch the sort of the base of it, the principal.
Yeah.
And it's like, no, you're meant to draw your principal down. And the whole point is the older you get, actually the less you spend because you're not traveling as much. You've built up enough things. You don't have to buy new stuff because you've already got all that stuff.
Yeah.
And so you're able to eat into your soup, into your principal. But yet what we've seen over the last decade or so is this real switch of, oh no, that's the inheritance.
Yeah.
It's like, okay, that's fine. But if that's just inheritance, then you should not be getting tax concessions for your inheritance. Sorry, actually, we should be taxing your inheritance
Yeah.
because wealth inequality is much greater than income inequality. If you look at income, you think, oh, rich people on, they're earning a lot more than the median incomes and everything. Well, let me tell you, when we look at wealth is of an order of magnitude worse when it comes to inequality.
And we're currently hosting Nobel Prize winning economist Joseph Stiglitz, who's done a huge amount of work into, I guess, the price of inequality. And it not only slows economic growth, but it also kind of overall just does a lot of damage to democracy in general.
Yeah.
So there's really good points, Greg. I did want to pick up the language that you were talking about around taxation, because I find that really interesting. Often in our political discourse, we demonize people who are seen to need quote unquote handouts, people who require or rely on for a short period of time welfare payments or income support.
Madam Speaker, the age of entitlement is over. It has to be replaced not with an age of austerity, but with an age of opportunity.
What we also want to do, though, Fran, is encourage people to have a go. We do have to reduce unsustainable expenditure. We do have to reduce what's been described as middle-class welfare if all of us are going to prosper in the years ahead.
The Prime Minister says, quote, being on drugs stops you getting a job. Well, the BCA and ACOS both say the low rate of New Start is an impediment to getting a job too. The government's not budging on that.
Well, we believe that the rate of New Start allowance is appropriate. I mean, that is obviously the judgment that we made at the budget. But we also believe that those Australians who are unemployed, who are on New Start, and who have a drug addiction problem, that this drug addiction problem is a barrier to them getting back into the workforce.
We see those people demonized, but we don't think in the same way about wealthy people and the concessional tax treatment that they get. That's not kind of seen as a drain on anyone. I mean, why do we think of these things so differently?
It's quite amazing, especially when it comes to retirement, because that great phrase, self-funded retirees. Like, I'm not on the pension, I'm self-funded. And then you go, did you hear me when I said that, the majority, 55% of all the benefits of superannuation tax concessions go to the richest 20%? And we're giving $19 billion a year to the richest 10%. $19 billion a year. That could have been, if we didn't have that concession, the government would have raised $19 billion. They could have use that to spend on a lot of things.
Bit like private education.
Yeah,
it's not actually that private.
Exactly. We talk about things where there's subsidies that actually benefit the wealthy and the rich. They are viewed as, oh no, they're incentives. That's not a cost. That's just helping me be less reliant on government. It's like, so the government is giving you money so that you're less reliant on the government. Is that how it works out?
At a cost of $20 billion a year.
It's the same, the diesel fuel rebates, oh no, that's not a subsidy on mining. You can't count it as that. And we're like, yeah, we can and we are and we will. And it's something that just fuels this debate of inequality, because what it means is we don't think about or report in the media the cost of things like these superannuation concessions in the same way that when we talk about, say, the cost of job seeker.
Yeah.
So you'll hear suggestions, we should raise job seeker to the level of the age pension. And the government will say, we'd love to, but,
can't afford it.
Budget's tight and everything.
But this is why the budget's tight.
This is why the budget's tight, because we give away so much money to people who don't need it. Remember the whole thing about we have concessions so that they deliver a public good. These super concessions were designed so that people would be less reliant on the age pension. Well, I'm sorry, if you had $3 million in your super, or if you have been earning over $200,000 for most of your life, you were never going to qualify for the age pension. So why were we encouraging you to save so you wouldn't be on the age pension when that was never going to be a thing?
Be the case.
But what we've seen is just this distortion. And so what it means is that when we talk about the cost to the budget, we have this warped view that, oh no, these were encouraging people, this wasn't a cost. And yet, As I say, 17, 18, $19 billion going to the richest 10%. For superannuation tax concessions, around $13 billion going each year to the richest 10% for capital gains discount. If we wanted to raise JobSeeker to the level of the age pension, it would cost about $5.5 billion. So if you're out there hearing a politician say, oh, look, we'd love to raise jobs, we just can't afford it. It's like, but you can afford to give $27, $28, $29, $30 billion a year each year to the richest 10% in superannuation concessions and capital gains tax discounts. And then think about it again. We're going back to who benefits from this. Well, who's benefiting from the superannuation concessions? Mostly men, mostly rich people, and actually mostly older people, because that's where you really get the benefits from the earnings and everything. Who's benefiting from things like the capital gains discount? People who are buying houses, who are buying their second house, third house, renting it out, then selling it and getting benefits from that. We know that's distorting their house market. Put those two together. Who's really benefiting a lot from this? Older, wealthy people who are able to use these tax benefits to get more assets so that they can buy investment properties, things like that. Who's losing out from this? Lower income people, younger people who are not actually getting any of the benefits of these super because they're young, they haven't got any super balance at the moment. And now we're also being told, hey, you know what's a good way to solve the housing crisis? Maybe raid your super.
Raid your super.
And
a lot of people did it during COVID as well.
And now they've got no super left. And it's a case of it's just perpetuating this inequality of who is benefiting from this for no actual public gain. We're increasing wealth inequality. It's just a horror show, really.
Yeah. Well, thanks for joining the show today, Greg.
Leaving on that very positive note.
You can find Greg's article on super tax concessions and Min's report on the topic via the links in the show notes. We would love to hear your thoughts on the show today, and you can reach out to us via email at podcasts@australiainstitute.org.au, or you can find us on Twitter at the Oz Institute with an AUS. And if you want to hear more about inequality, both in Australia and around the world, Nobel Prize-winning economist Professor Joseph Stiglitz is in Australia now as a guest of the Australia Institute as part of our 30th anniversary celebrations. There are still some tickets available, and he's visiting Hobart, Melbourne, Canberra and Perth, so tap the link in the episode description for more details. Our theme music is by Jonathan McFeet from Pulse and Thrum, with additional music from Blue Dot Sessions. I'm Ebony Bennett. Thanks for listening.